To live valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker AMD, Advanced Micro Devices. Very popular company amongst retail investors, and kind of just in general, I'd say has probably a disproportionate amount of discussion devoted to it in the investment community. Not because it's an uninteresting company, it definitely is, so maybe that disproportionality is well deserved. And it's definitely been a company that's been on my my own horizons and viewpoint for pretty much the entire time I've been investing. In fact, at one point I was an investor in AMD, though I am ashamed to say that I sold out of it way too early. Did make a little bit of a profit, but one of those things where you look back several years later and be like, oh my gosh, I cannot believe the mistakes I made. But either way, we've kind of just been paying attention to it vaguely in the background, noticing it and seeing how great it's been performing both operationally and financially. But it was always overvalued, so we didn't really ever bother to come back around to value it again. But yet, as with the market has been dropping, it's starting to look a bit more and more attractive, or at least attractive if you try to take a significant amount of future growth into account, which in general most people in the industry certainly seem to believe AMD has ahead of it. But we'll get into some of those details. First, we'll take a look at the portfolio watch list. As you can see, it's pretty much about the same as it's been. Small movements here and there within the portfolio. As with normal, I've made my purchases on Monday. I did buy some more Smith & Wesson this week, as well as a bit more Interfor forestry, as well as some Buckle, as well as made some other adjustments to other companies. Oh, also some Intel. I did buy some more Intel, and then made some other adjustments to some of my more macro positions, as well as short positions and kind of readjustments to things like that. Finally getting my cash positions back into kind of alignment with where I want them to be, so I can start to plow a little bit more money into the market, both through the cash pile that I've set up inside my portfolio, because I do have a decent amount of cash on hand, but also with the with new money that I'm now able to inject into my portfolio, which is something that frankly I haven't been able to do for a little bit of a while. Just in my own personal finances, it's been a little bit more of a slower period, what with the fact that I am a full-time student. But anyway, before we do get into some of the specifics of the company itself, I did want to talk a little bit about economics. We did get some economic data in today. In particular, they did there was a release for the new home sales, which were up pretty significantly month over month, up 29% month over month, but which they were down pretty significantly over the last several months. But either way, it was above what was expected, which is, I think, has something to do with some of the positive reaction in the market today. You could also say it's just a little bit of a bounce back due to some of the negative days in general. But with that, we also saw the housing price index come in. The housing price index year over year is still up about 14%, but on the month over month level, it was down about 0.5%. So we got some positively high levels in the home sales relative to expectations, while we still got the housing price index itself to come down, which is kind of like a Goldilocks scenario as far as what we want to see in cooling in the housing market, but maybe in a way that's less devastating. So that I think that has something to do with the positive reaction in the market today. And then beyond that, I did want to talk a little bit about interest rates and how that relates to discount rates in general and PE ratios in the market itself. This is the index of the 10-year treasury, the TNX, and as you can see, we're hovering just below the 4% line here today, very significantly. This black line is the 15-year average. So you can see the 15-year average of this yield is 2.84%. And so the fact that we're up about close to 4% shows that we've made significant progress in moving the interest rate up, considering it had bottomed up around 0.5% or so. This brighter red line is the 1-year average, and even that you can see that had went from basically about 1.5% up to 2.25% or so. So significant movement in the interest rate. And even just in the last week, we've had a huge move in the interest rate after a little bit more of a confirmation with the most recent Fed meeting that they plan to keep moving with their tightening plans and do it for longer. So the market started to really recognize that fact and be like, okay, well, this index needs to shoot the rate upward. But I did want to talk about how this affects PE ratios and discount rates specifically, because a lot of people, I think, they kind of know that interest rates go up, but they don't necessarily think about it super intuitively. So I kind of just wanted to show in a relatively simple example sort of how it works. As I had shown, the 1-year average interest rate was about 1.5% or so for a long time, and you could we had discount rates as low as about 6% for a lot of the mature parts of the market, which basically means people were accepting about a 6% yield on expected cash flows for lots of the mature market. And if you subtract the two in between that, that gets you what's called the risk premium, the equity risk premium, which means the extra amount of premium that you would have to ask for above and beyond the yield in order to justify investing in the company. You could also think of it as a times versus that. So you can think of how many times versus the yield is it. And one way of thinking of that is that we want investors want at least 3 times more than the bond itself, because you do have to add in the original amount. So that would actually be 4. So that ends up being, say, 4 times the original bond amount in order to invest in the company. That just sort of one particular example. And the implied PE ratio of that is to take the risk premium and divide that into 1. 1 divided by the risk premium ends up with an implied PE of 22, which we saw, for example, that was maybe around the average PE that the S&P 500 was trading for like a year or two when we kind of had these dynamics. Now, as I was just talking about, we've already pushed the average interest rate for the last year up to 2.25. You can do that, and then that affects the risk premium. So people would ask for more risk premium, or if the premium has moved up. Currently, for example, we have a discount of something in the range of about 9.5% as I calculate for the S&P 500. So if you do that, that ends up giving you a risk premium of 7.25%, which brings us back into alignment with that 3 times extra or 4 times total of the original yield amount. So you can see that basically the amount of premium that the investors are demanding above the 10-year in terms of proportionality hasn't changed, because you can see that these numbers are the same with the original dynamic. And with that, you end up with a PE of 14. Now, our original PE was 22. If you go to a 14 PE from a PE of 22, that ends up with a 37% decline in the price. So this should gives you an idea of exactly why it is the markets have crashed from where they were. This 22 kind of represents where the markets had topped out in the last quarter of last year. And the 14, I would say, represents where we ought to be with the current expected cash flows and the average yield that we've had over the last year. And that doesn't even say that is where we are, because I think we're actually more like a 16 or 17 right now or something like that. So that just goes to show that it's a given that the market should be crashing right now. And in fact, based off of this math, we should be going a little bit further based off the current numbers. What's to say if the yield goes up further? What if this number turns into a 3%? Well, what if we still have to return the dynamics to the same? Well, then we're going to have to push the discount up to 12% to get this back to a 4 and a 3. That brings the PE down to 11. Now suddenly you're at a 50% decline. So you can see how dramatically the stock market can start to decline as yields move up and risk premiums associated with those yields are demanded to stay the same. Now, they don't have to stay the same. They could remain a little bit less. Maybe people ask for a little bit less premium than that and only stay it down to a certain level. And that can maybe lessen the effect. But either way, there's a dramatic amount of decline automatically implied just by the interest rates moving up. So anyway, enough economics and kind of interest rate talk. Like I said, I just kind of wanted to cover that a little bit so people have an idea of what it is that's going on and why it is that the markets are reacting the way they do with the interest rates moving up the way they are. Now, I also wanted to cover something that I had talked about a little bit in my last valuation, which was this industry data spreadsheet that I had put together. I had showed parts of it, basically the different sections right here, and how I was going to be using this in my evaluations moving forward, and that this is essentially a compilation of many other data sets, all coming from Aswath to Modron, which I've relied on for my other previous valuations, in particular for the betas, as well as the sales to capital ratios, as well as the net margins of industries. I've relied on these data sets, but I put together a time series of all of those metrics, as well as many other metrics like tax rates, operating margins, R&D as a percent of sales, EV to sales ratios, PE ratios, gross margins, dividend yields, sales of the industry itself, all sorts of things that I put together here, which is frankly an overwhelming amount of information and kind of difficult to look at, which is why I also put together this neat little front page, this comparison tool, which makes it easy for looking the information up. When you look on any of these given pages in the left-hand column, you can see that there's a number associated with each of the industries. They are listed alphabetically, and there are 94 industry groups here, along with a total market and a total market without financials grouping. So 96 total aggregates to look at. And in the lookup table, all you have to do is type in a number, and it will automatically pull all of this information associated with that particular industry for whichever one you put, and also tells you which industry is in the spot there. So I worked on this over the weekend. I'm pretty proud of the work I did and how this came out together. And then obviously, as you can see to the right of that, there is a second spot where you can then compare one industry against another, which is pretty useful to be able to do. And for example, today we're looking at a semiconductor company. So I do have all the semiconductor data up here to look at in various ways. And then I also have it so that you can compare it against the total market aggregate right here. And if you want to include finance or not include finance, all you have to do is check the box and it'll automatically change out the data for that. So this is a pretty useful data set that I've put together. Like I said, it's really just a compilation of literally a couple hundred different spreadsheets that I already had access to. And I knew where to find different things, but I really wanted to put it together into one solid piece to make it very useful for me to look things up. And so like, for example, here today, like I said, we're going to be looking at the semiconductor industry. So it's very useful to have all this information right here. I can see that for the last 3 years on average, the R&D as a percentage of sales for the semiconductor industry has been about 18%. And so we can compare that to how much R&D AMD has been spending, for example. The gross margins that they've had over the last 5 years as an average, so maybe like a longer term average for the gross margins, have been about 55-56%. We can compare that for AMD. You could also compare their stock compensation for, if that's something that matters to you, comparing debt to equity ratios, net reinvestment, adjusted ROE or return on invested capital, all sorts of things. So it's very, very useful information, I think, for using our valuations looking forward. So with that, we can start to actually take a look at AMD more specifically and get into the company's information itself. AMD was founded in 1969. They are traded on the New York Stock Exchange. They do have their primary currency in US dollar. I have all their major links right here. Their current CEO is Dr. Lisa Su. She joined the company in 2014, or she was elected to a CEO position in 2014 after joining the company a couple years prior to that in a relatively high upper management position from the get-go, being a part of the technology development teams. It is part of the semiconductor industry, as we've already talked about. They design a significant amount of semiconductors in the specialized technology spaces, such as like for video game consoles and appliances, as well as a significant amount of server application. Hey GT, what's up? Welcome to the chat. Their top customers are pretty widely varied. They're including Microsoft, Sony, HP, Dell, Lenovo, technically also somewhat competing with certain of their customers in certain ways, especially like, for example, Microsoft, as well as other competitors being Intel, Nvidia, and Apple particularly. Then major, not necessarily suppliers, but companies that are super important for their operations, but due to their manufacturing relationships with them, being TSMC, Taiwan Semiconductors, as well as Global Foundries, these being two of the major semiconductor foundry companies globally for the vast majority of the semiconductor industry. Their next report date is expected to be November 2nd. The revenue guidance that they provide is at the midpoint of 26.3 billion for 2022. And other guidance that they provided that I thought was useful was that their OPEX, operating expenses as a percentage of sales, is expected to be about 24% for the year as well. Analysts from Yahoo provided 26.2 billion as a midpoint, according to 36 analysts, and 29.56 billion according to 36 analysts for next year. And the earnings, according to the analysts on Yahoo, it's $4.36 for this year, according to 32 analysts, and then 34 analysts said $4.87 next year. So we'll take basically all that into account when making some of our projections, but also a couple other specific things, which we'll get into in a little bit. They do not have a cash dividend. They do have $7.4 billion of buyback authorization currently in place, which equates to about 6.75% of their current market cap. The inside holdings is less than 1%, pretty measly amount of inside holdings, but it has actually jumped pretty significantly in the last 6 months, almost doubling from measly to measly, but either way, somebody's buying. 68.5% of the stock outstanding held by institutions, so pretty significantly owned by institutions, which it is a pretty large major large cap, so I guess that's to be expected. Short outstanding 1.92% as a percentage of float, no real difference there. And the short ratio is incredibly short, so nothing particularly to note there. 3-month average volumes 80 million shares versus the 10-day average volume 77, 78 million. So a little bit light in the last couple of weeks relative to the 3-month average. Now we're going to take a look at a decent amount of the slides here that they provided in their most recent presentation. I'm not really getting into super specifics of like a lot of the technology. I'm not going to pretend to like be an expert in the technology. I do actually pay quite a lot of attention to the space, but it's definitely something that like when I pay attention and try to listen to a lot of the information on the technology, a lot of it does go over my head. And part of my interest in valuing this company isn't necessarily because I think like I'm going to be able to bring something specific about the operations of the company or the technology itself to the table. As per normal, is really, I think I'm just pretty good at the finances part of doing valuations. And I do find this company to be very, very interesting. But they do have major technology platforms. There's Zen 4 CPUs, as well as RDNA2 and CDNA2. They are in the CPU space, as well as the accelerated processor unit space, the APU space, as well as the GPU space. So they're pretty wide variety across the different types of chipsets, and then they're pretty wide variety across the different applications, as well as we can see here, having different placements in data centers, client operations, as well as gaming chips, as well as embedded technology chips as well. Now, some of the other slides I kind of want to talk about, you can see their revenue trend, which has been pretty dramatic over the last couple of years. There was one specific other slide I wanted to point out, kind of relatively near the bottom. Also, you can see their financial outlook, which I already talked about some of the specifics of it. You can see the revenue guidance I already talked about, and I had mentioned the operating expenses, but they also did guide for their gross margin about 54%, which is really just in line with their most recent margins, and also relatively in line with the industry as we were kind of talking about. And then they're also guiding for a significant decline in the share count, so it seems like they do plan to be using some of that buyback authorization, but I don't know how they're necessarily coming up with that math itself. Yeah, and then they talked about they did use a significant amount of it in the last 2 quarters as well. I'm going to say ESG, not necessarily concerned about that. But yeah, here it is. I did want to mention this, that they also, they themselves represent that their TAM, their total addressable market, is 300 billion, which I kind of wanted to bring up in particular with comparing that with the information I have here in the industry data set, because I used that when working on my revenue projections for the company, which we'll get into a little bit. One other piece of information that the data sets had available for me was the sales for these industry groupings. And I was like, yeah, this is going to be a really useful thing to start using a little bit more in the valuations more regularly. Now, it's worth noting that when it comes to like this particular data set and how it works, it's basically only companies that designate themselves as part of that industry. So if down here we have the semiconductor industry and the sales therein, it's only going to be applying to companies that they themselves are represented as specifically semiconductor companies. And if we come down, take a look at that, you can see that, for example, the sample size itself has been anywhere from 100 to 67 companies over the 8-year period that we have right here. In the most recent year, it was 67 companies that represents. So 67 companies is where those sales come from. And so it's not necessarily representative of all the sales spent on semiconductors. It's just representative of the sales delivered to companies that they themselves call themselves semiconductor companies. But with that caveat taken into account, we can see that actually in the last year, the total sales of the semiconductor space, according to this data set, was actually 289.2 billion, which is not that far off from this $300 billion TAM that they mentioned there. So I thought that was very interesting when those things just worked out so neatly with itself. I do also have included for the 3-year, 5-year averages for those sales, rather than it just being the average of the number, I have the growth rates for it here. So we can see that over the last 8 years, the semiconductor space, or at least the sales delivered to companies that label themselves as semiconductor companies, grew at a compounded rate of about 9% for the last 8 years, about 12% for the last 5 years, and then about a little bit less than 8% for the last 3 years. Again, all on compounded rates or so. So very, very interesting to think about. And one other thing we can also take into account is that the total market capitalization of that same group of companies is 2.4 trillion. And then we could compare that with the market capitalization of AMD, which itself is about 100 billion. So, the relatively small amount of market capitalization or so. So anyway, that was just, like I said, a couple of specific details I wanted to point out related to the data set that I thought was neat when their TAM was relatively close to like what was apparently considered the semiconductor space for this. You could also throw on, for example, I have over here the semiconductor equipment industry, which is a separate segment in this data set. There's another 71.5 billion or so right there. So if you just added it together, boom, you would have 300 billion. And it's worth noting that this is also just a US data set. So this is the sales to US companies. If we included foreign semiconductor companies, then that would add in a whole other separate thing. And I am eventually planning to make a global data set version of this. I just needed to fully finish this one so it would be easier to do the second one. But anyway, back to AMD. So we can come down here to get into the segmentation of the company and how that works itself into the discount rate that I'm using for the company. That is related to the data set itself as well. We can see the adjusted unlevered beta for currently that I have for that industry is 1.09. So that is the adjusted levered beta that I'm using for them right here. The sales capital ratio I'm using is 0.75, which if that ends up being the 5-year average for the industry when it comes to, and it's also the 3-year average. That's right. For the sales to capital ratio, I tend to prefer using the 3-year average because I want a number that's a little bit more representative of what's currently being spent on the capital in the industry, because current spending and capital is pretty related to current and future returns in the industry as well. But then when it comes to margins, I typically prefer to rely on a little bit more of a longer term number, because margins tend to have a little bit more variance in the year-to-year number. So for the margin of the industry, we might rely on a 5-year or an 8-year average, at which point we can see 22.1% and 19.5%. I'm pretty sure I put 19.5% in here. So against their industry, we can compare those two things. Their margins are actually pretty good, or at least in the last year or so. In the last few years or so, they're not so great before that. And then their sales capital ratio, it's a little bit more of a complex question, which we'll get into when we do the financial numbers themselves. Now, one other thing, I usually do the geographic portion of the equity risk premium based off of the geographies in which the company is currently operating its business, which is one of the reasons I prefer to rely mostly on information in a 10K and not really update to 10Qs too often. Now, for this particular valuation, and I did this with my last valuation as well, there were significant changes in the business very, very recently. In particular, in the last quarter, they completed their acquisition of Xlinux. And so that had a dramatic shift to their total asset base relative to their sales, and also a huge shift in their total sales. And so I really wanted to include those things. Since this is a high growth company, we really wanted to make sure we had the correct basing, but to make our assumptions off of. And so as a result of that, I don't have entirely accurate information as far as the geographic disbursement of their revenues, because we're not going to get that until we get the next 10K, which is the first 10K that they'll have released post the acquisition of Xlinux. So to kind of compensate for that, I'm relying on a relatively simplistic method of saying half the global international equity risk premium of 5.26 and half the US equity risk premium of 4.24, just kind of as a fail safe, because I do know it's going to be the majority US, but then a significant amount of reliance on global, in particular East Asia equity risk premium. So halfway between the two gets me an equity risk premium of 4.75 before being adjusted for the current year. And if I adjust for the movements in the current year, that ends up at a risk premium of 6.59. And then I add the debt effect onto the unlevered weighted beta of 1.09, which they actually only have a debt ratio of about 2% or so, debt to equity ratio, market debt to equity ratio. So as a result of that, their levered beta only ends up as 1.11, and that brings their total cost of equity up to 11.26%. Now, I also am doing a little bit of an estimation in much the same way I am with the equity risk premium with the debt, because that's another thing that they usually give much more specific information on in the 10K versus the 10Q. And so I'm not actually lining up super specific information to get a slight difference between the market value and the book value of the debt, and I'm just relying on the assumption that they're approximately equal, which for most companies they are approximately equal, especially highly creditable companies, and I think AMD would definitely classify. So I'm not necessarily concerned about that, but it does mean that I'm not actually sure what their weighted average maturity is or their interest rate. But in their most recent year, they had an interest rate of 3% versus an average for the last 3 years of 7.54%. So I decided to just put 4% in there on the assumption that it has to be higher than that 3% because interest rates have moved up. So it's a little bit of a bludgeon assumption there. And then I'm using a 5-year weighted average maturity because that's kind of my typical average for most companies. Again, I could be way off on both of those assumptions, but both of these numbers barely affect anything in the valuation at all. All they really do is give me an estimate of my weighted average cost of capital versus my cost of equity, but I discount using the cost of equity method, and so it doesn't really make that big of a difference. This is really just more for analysis of the company purposes more than the actual valuation. So both of those assumptions don't really have too much of an effect on the valuation. The geographic part does have a little bit of an effect, but like I said, I don't think that
that bludgeon is too as much of a big deal personally. So that's fine. And so with that, we can take a look at the financial history of the company. I have the financials of the company going back to 2013. And then I have it listed here as fiscal year 2022. But as I was kind of just saying, this is actually the trailing 12-month information, which includes the last 2 quarters of 2021. So there is a little bit of overlap between these 2 columns, technically speaking, but that is what it is. I don't really care too much. Just kind of, like I said, keep getting a rough idea of where everything is in line with that. So anyway, you can see that their sales went from 5.3 billion in 2013 up to 21.5 billion or so in the most recent quarter, which is pretty dramatic. And you can also see that they had actually dropped below that into 2015. That's actually where their revenues had bottomed up. Most people are pretty familiar in general with the story. AMD itself was having pretty rough times. It was relatively close to going bankrupt, so it wasn't exactly innovating, wasn't exactly keeping in line with their competitors, and also wasn't providing good competitive price points as an alternative to not having superior technology until and that's one of the reasons that Dr. Lisa Su is so heavily acclaimed, is that she was a great a technology expert to bring to the table to help also then executively operate the business into a much more stellar and controlling operating position that it now has. We can see right here up through the years they grew at 20%, 20%, 4% there, 45%, 60, 70%, 2021, and then another 31% again in the kind of the slight overlap here. So huge dramatic increases in revenue, 4% compounded rate on the rate between 2013 and 2018. But then up to more of a 32 to 33% for the next 5 years. So going from mid single digits to low 30% is pretty dramatic as far as like a compounded move in total revenues. Now, that's the part where we have to start to be a little bit reasonable and take things a little bit more careful and take a serious eye, because a lot of people would probably just assume that they can grow at 30% for the next 5 years or maybe 20%. So we do have to kind of be careful in making our assumptions of the future. Like I said, I have a relatively simplistic revenue model to show you guys for that. But either way, we can take a look at that in a little bit. Also want to take a look at their gross margins throughout this period. You can see that they went from pretty poor gross margins. They had 30s and then it kind of bottoming out in the 20s there for an average of, what was the average for the first 5 years? 31% for the first 5-year period. And then it started to dramatically take off. It started to take off in 2017. But either way, coming up to an average gross margin of 44 to 45% for the next 5 years. And it's ended at 50%, 51%. Which again, we were comparing that, for example, against the gross margins for the industry, which we saw was pretty consistently in this like 55% across the entire time frame, it seems, or so. So they're not really quite there yet, but I wouldn't necessarily punish them for the fact that they're underneath their industrial expectation for the gross margins. Like if it was the case, if they had been below that rather consistently for the entire time, but not moving upward. But we can see that they've been dramatically moving pace upward with it. I would be shocked if they didn't end up with gross margins higher than their industrial expectation in the next 5 years, frankly. So anyway, we can also come down to take a look at their operating margins, kind of similar situation, which we can do. Taking a look at their operating margin, the average operating margin they had for the first 5 years was actually negative 2%, which again was showing how they were having difficulty remaining solvent, and there was serious questions of whether or not they were going to go bankrupt or not. And then now for the last 5 years, it's been an average operating margin of just under 14%, ending at 16 to 17%. For that, we can also take a look at that. The operating margins again for the industry for the longer terms, ending in it's like this low mid 20s, mid 20s or so, and then still kind of mid 20s in the most recent years. So long way to go as far as that goes as well. But it's worth noting that that's an unadjusted operating margin, which means it's including the R&D costs, at which point adjusted operating margins might tell a slightly different story, but we don't necessarily need to get into all the specifics of that necessarily right now. But also reporting net margins, you can kind of see the same thing. Not going to talk about the industrial expectation. We know that they'll be under that. Either way, negative 7% for the first 5 years, up to 14% for the next 5 years, which is roughly in line with where they currently are, so to speak. So they did have a pretty high top out of 25% in 2020, come down to 15%, but that seems to maybe be where the 5-year average was. Now, if we come down to look at the R&D capitalization, which gives us an idea of like what their true earnings would look like if we considered R&D as an asset rather than just as an operating expense over a 5-year amortizable life. which really only gives us 5, maybe 6 years worth of reasonably accurate numbers. But either way, that gets us, we can see, for example, the average corrected net income that I have for those 6 years is 2.4 billion or so. If we come up to the GAAP net income for those 6 years, it ends up being 1.2 billion or so. So almost double the net income effectively is if you actually capitalize the R&D. And that's not just adding back all the R&D, that's adding back the R&D, but then subtracting out amortization of the R&D, which basically means you're only going to get a continual rewardance for the R&D if you're effectively continually increasing the amounts of R&D you're doing. That's kind of how this works. So it rewards companies for pouring money into the R&D over their lifespan, which we can definitely see. You can see, for example, they had their R&D growing at a compounded rate of 3.6% for the first 5 years, which was below their revenue growth of 4% for the first 5 years, but pretty much in line with it. And then they had R&D growth of 27% for the next 5 years, which is below the 32 to 33% for the revenue growth, but also pretty relatively in line with it. So it shows that they were basically doing as much R&D as they effectively could get away with according to their sales. Now, coming down to their cash flows, we can take a look at their overall investment in the company. Now, the adjusted net capex line that I have right here takes capital expenditures, acquisitions, as well as working capital changes, as well as that R&D capitalization that we talked about, and boils all those things together into one number to effectively take an after-tax profit income number and subtract out whatever amount needs to be invested for reinvestment in the company. So that gives us an idea of just how much they've been reinvesting in their business on a whole. For the first 5 years, on average, it was just under 600 million per year or so. And again, 600 million per year against a corrected net income of maybe less than 200 or so million. So effectively speaking, they were reinvesting more money than they had in profit for the first 5 year period. And then for the next 5 years, the amount of reinvestment they've done has been about 1.4 billion. And again, they had about 2.4 billion or so. So now they've actually eked out about $1 billion or so worth of leftover cash flows on average per year for the next 5 years. That means post reinvestment, which is great. That's what we call free cash flow. And then there is also then debt issuance to take into account before that gets us to our free cash flow to equity line, which for the first 5 years, it was about 42 to 43 million dollars per year that they were issuing in debt, basically just enough debt to keep afloat, but they were also issuing some equity to keep afloat as well, which is part of the reason that their stock had crashed to absolutely nothing. But then they're also issuing a little bit more debt in the last 5 years, issuing about 278 million per year for the last 5 years. Most of it coming in the most recent year. They did issue a significant amount of debt in the most recent 12 months, which is fine, I suppose. Like I said, they have basically no debt to equity ratio, so they can effectively afford to pick on some debt. But either way, we end up with free cash flows to equity, which is post debt issuance and equity issuance free cash flows of negative 243 million for the first 5 years on average. And then the next 5 years, we ended up with an average of 1.7, 1.8 billion. So that's cash flows. That's cash flows that belong to the shareholder. That's great. And for the full 10 years, what ends up with an average of 773 million. So they made enough cash flows in this last 5 years to more than pay up for the lack of cash flows in the 5 years previously. And then we can also see the amount of cash flows that they've paid out to their shareholders or issued from their shareholders. For the first 5 years, they were diluting their shareholders about 144 million per year, most of it coming in 2016. But either way, a decent amount of dilution per year. And that dilution continued all the way through 2020. But either way, for the next 5 years, the average ends up being about 1.1 billion in total common paid out, which again, we were saying it was like 1.7 billion that they could pay out. So they were paying out to their shareholders pretty significantly in the last 5 years, but they're not overpaying their shareholders either, is what that shows. So pretty good to see. And then that actually did also equate to total common yield of still pretty much like less than 1%. I can see the average here. Excel doesn't actually want to make it relatively simple for me. It's putting it in dollars for some reason, but I think the average ends up being less than 1%, close to 0% as a total common yield across the 5 years, partially because we did have a negative 3% yield in 2019. And that's because it's a simple yield. If we took the total common paid out and then divided it into like the average market cap over the 5 year period, it would actually be a lot more positive. But for the last 2 years, which is the period in which they were paying out, it ended up being more like a 2% yield or something like that. So maybe that gives you an idea of maybe the type of yield that they might be paying out in total common yield in the future time frame, which again, we did talk about the fact that they have 6 to 7% of buyback authorized currently. So that's where that could possibly come from, is that it might be 3 to 4 years worth of buyback authorized currently. So anyway, we can come down to returns on invested capital, which gives us an idea of how much returns they were making on the total capital base before paying to equity shareholders. This is returns to total capital shareholders, which is why we still see relatively positive numbers even for the years where they had significant losses, because they weren't making so much losses that there wasn't a return on capital. It was just so much losses that there wasn't a return to the equity shareholders in an effective sense. But either way, we end up with about a 13.5% for the first 5 years, and it comes up to about 22% for the next 5 years. Again, 22% for the last 5 years or so. Returns on equity for the first 5-year period, it still ended up being about close to 30%, and that's partially has to do with the distribution of the assets in their balance sheet. So they were taking on significant losses in their income statement, but those losses hadn't actually showed up in such a way that their balance sheet was totally destroyed, which meant that their equity base still existed in such a way that they could have positive returns on it for the most part, except for 2015 there. But either way, for the next 5-year period, it ended up being a little bit less than that, 23 to 24%, showing that their balance sheet was coming back more into a little bit more of a stabilized position. Coming to that actual balance sheet, we can take a look at that, seeing that they went for their current assets for the first 5-year period, it was averaging about 2.5 billion or so. And then for the next 5 years, it averaged about 7.1 billion or so, but it's ended most recently about 13.4 billion. So you can see right here, this is basically what I was talking about, the difference between the trailing 12 month, which is the second quarter ending balance sheet right here, versus the fiscal year ending balance sheet. They had basically dramatically jumped their total asset base with the purchase of Linux. And so I was like, well, I really need to bring that asset base into the picture in order to bring an accurate valuation. So we're going to go ahead and include those numbers. So yeah, the huge changeover. The current assets ending at 13.4 billion, with their total assets being 67.5 billion, a significant portion of the total asset base now being the goodwill that they use in the purchase of that company. Excuse me. And now the current liabilities. Now that part hasn't actually jumped up as dramatically. Their current liabilities for the first 5 years averaged 1.4 billion, averaging 3.3 billion for the next 5 years, and ending at 5.5 billion. So they do have a huge jump up in the current assets, but actually that made their total ratio of the current assets to current liabilities jump up pretty dramatically as well. Now, they do have a significant amount of cash and marketable securities on their balance sheet, which partially shows where they can get the cash to do all the buybacks that they're talking about. So they actually do have the ability to do that relatively with the money on hand without having to do any financial shenanigans to do so, which is good. And then also we can see that their accounts payable is less than 2 billion versus the 4 billion in receivables they have. So they're well covered in total bill amounts that they have as well. 2.6 billion in total inventory. So that's one thing to keep in mind as well, which is relatively in line with maybe the total rest of the current liabilities. That doesn't take other assets into account, but either way. And then beyond that, we have total liabilities of 12.3 billion. So there is basically another doubling of the total liabilities, but compared to the total assets of 67.5 billion, you can see that, yeah, the total ratio between assets and liabilities jumped dramatically in the positive favor with the purchase of Linux. So it's a huge improvement in their the total cleanliness of their balance sheet, I guess you could say. Though we'll see how that actually all works out once maybe they filtered out some of the excess assets, got rid of and amortized away some of the goodwill, maybe impaired a few of those assets, as well as got rid of all that cash by buying back some of the shares, which would have an effect on the equity as well. And speaking of that equity, we can see the total retained earnings of the company was pretty significantly negative for the entire time frame, actually, which shows that where they did actually have a dramatic decline in their total amount of the earnings. But like I said, they had managed to at least have their capital base in such a position that it had allowed for the returns on invested capital to remain totally positive, which is to say that their retained earnings was hugely negative, averaging about negative 7.1 billion or so for the first 5-year period, and yet their total shareholders equity still averaged positive of 266 million for the 5-year period. For the next 5-year period, the average shareholders equity was 14.5 billion versus the retained earnings averaging negative 4.1 billion. So there was an improvement in the retained earnings over the 5-year period. In fact, now it's less than $1 billion away, which basically means, they could fix that within a quarter or something. So no real problem. They finally fix their retained earnings and balance sheet problem, which, like I said, relatively speaking, they had actually managed it. It sounds like they had basically just eaten away their earnings rather than eaten away the entire total equity, and that is to say that they still had a significant amount of total paid in capital covering those eaten earnings, and they didn't really go past that point too dramatically before starting to turn things around. And then also now there's a lot more capital in the business now as well. So Anyway, we can come down to take a look at the sales to capital ratio, which is one other of the major reasons why I wanted to include the trailing 12-month numbers, to make sure that we include the current asset base, because that's going to have a dramatic shift to the sales capital ratio. You can see that their sales capital ratio for the first 3 years prior to the Excellinx acquisition was 1.15 or so. Pretty high sales capital ratio for the industry. Again, we had seen that for the last 3 years on average, the industry was like 0.75. And it has to do with partially the fact that they're not really a manufacturer of semiconductors. They're more of a designer of them more than anything else. And so that means that they're not necessarily taking on a huge amount of capital base, but then that dropped pretty significantly when they took on the Excellinx acquisition. We can see for the entire time frame that remains pretty consistent. There isn't really a point where they had a lower amount, so you can say that they weren't necessarily investing too much dramatically in the business. This partially, like I said, just has to do with the nature of the businesses. They're more of a designer of semiconductor chipsets more than they are a manufacturer of it, and that could change in the future for all we know, but that doesn't seem to be the situation moving forward. And again, that's partially why we had talked about their reliance on TSMC and Global Foundries. And that's also one of the major reasons why they have such a strong competitorship with Intel, because Intel is a pretty significant manufacturer, and sometimes they have to make deals with each other to make trades that are convenient and not operable for both. So anyway, we can start to take a look at our projections for the future of the company and how that relates into the total valuation as I put it together. As I had said, I did put together a relatively simple model for projecting the revenues of the company, and this is based somewhat off of kind of like the similar thing I was talking about with the industrial data set that I have right here, that I do have the total sales amounts. Now, I had also said that I have basically the same spreadsheets, but in global data set format. I just haven't put together the spreadsheet for that and the comparison tool for that. But I did go and dig into the numbers to get the information so that I could do this valuation relatively accurate. I wanted to know what is the total sales in the industry globally for semiconductors in 2021. And so while in the US, the semiconductor companies had 289 billion in sales, globally the semiconductor labeled companies had 664 billion in 2021. And then I also went and found out what that same number was for 2016, so I could get the 5-year compounded growth rate. That number was 377.9 billion. So it grew at about a 12% clip globally between that time frame. Now, I wanted to find out what their total market share was, so I took AMD's revenues for each of those timeframes as a percentage of that total amount to get an idea of what their market share was in each of those years. You can see the market share of AMD in 2016 globally was about 1%, a little bit above that. In 2021, it was about 3.25%, which that percent grew itself at a compounded rate of 23%. And that's not an increase, like I said, it only increased about 1.5%, 2% or so. But it grew at a 23% compounded rate if we're talking about the same point there. So while this had not quite doubled, but basically a little bit less than doubled, this showed that this had more than doubled. This had grown at a much faster clip. So I basically built my entire revenue model based off of this. I was like, well, where do we think the semiconductor industry is going to be globally in 2027? I was like, maybe it might grow at basically the same rate. So I put possibly that same rate here, which is about a 12% clip. And that gets us to 1.1, 1.2 trillion in 2027. And then I was like, well, maybe it doesn't grow. Maybe we pulled forth so much growth that the semiconductor industry doesn't grow hardly at all for all the way through 2021, which I don't really think is super likely. But I also don't think it's super likely it grows at 12% clip for the next 5 years either. So anyway, either way, that gets us with the same number we have here, 664 billion. In 2027. So those are my best and worst case scenarios that I'm going to rely on. And then with that, I also then give a market share assumption where I'm like, well, in best and worst case scenarios, where do I think AMD's market share could be? Now, I was pretty pessimistic on where I thought the worst case scenario semiconductor sales could be. So I was like, I'm not going to be that pessimistic on the worst case scenario where I think AMD's market share could be, which is to say that I think in the worst case scenario, the market share is just going to be where it currently is. Because I actually think they're very much on the upswing in market share currently. We're not on the downswing. I don't think they're peaked either. So if anything, they might be at the exact same position they are currently in the worst case scenario. And that's also while the semiconductor space is also at the exact same position that they are. Which, I mean, if the semiconductor industry is at the exact same position it is in 5 years, first of all, like I said, that would be terrible. but also then it would probably be very difficult for AMD to remain at the exact same position it is. But either way, so if that's the case, that ends up with 21.5 billion in the worst case scenario for sales. And then in the best case scenario, I was like, well, where do I think they could end up as market share? Now, this is the part where you might argue and be like, well, I think it could do much better than that. I think they could get a much higher clip of market share, but I don't think that they can actually grow the market share that dramatically. In fact, I don't think that they could increase it by the same nominal amount in the same time frame. So that's to say that while this actually grew at, what is it, 3.25 minus 1.14, that's 2.11%. I don't think that you could add 2.11% onto that as easily, relatively speaking. It would be just as hard. And so while I am technically allowing them in the best case scenario to do that, I'm actually allowing them to grow at effectively half the speed that they did previously, which means at 11.5% or so, which basically gets me to roughly that same point. You'll notice that that's at half the speed. So to get roughly the same amount of growth, you end up having to going at half the speed, which I think in the best case scenario, that's the best you could hope for. So in my case, I'm going to say 5.63% is the best case scenario market share, and the worst case scenario is 3.25%. Again, this is globally. This is a global market share for the semiconductor space, and that gets me revenues of anywhere from 65.6 billion to anywhere to worst case scenario 21.5 billion. And I'm going to use those as my assumptions for the valuation. If I plug in numbers that gets me to roughly to those points, we end up right around here. I actually did round up slightly. So for the worst case scenario, I actually did do a slight bit of a favor and round it up so that it ends up at 24.2 billion. So I'm actually giving a little bit of a boost to my worst case scenario in that case. And I'm also giving a little bit of a boost to my best case scenario too. I basically just rounded up to even fives because I did note that I thought that I was being reasonably conservative in these assumptions. So I was like, you know what, we can round up to even fives, which got me a little bit higher, a couple billion more in each of those scenarios. And then the midpoint, I chose to make it at 25%, which leans pretty significantly towards the positive outcomes, I think. You could easily argue that maybe a better midpoint would maybe be about 20%, but I actually do think that AMD is pretty likely to have significant growth. Like I said, like I personally think that they are more on the upswing than the downswing, so I'm willing to actually give them a significant boost for that. Then I am going to do one little thing to kind of knock them back a little bit of a peg, but it's a pretty small peg, which is that I'm actually going to be relying on the average between 2021 numbers and the trailing 12-month numbers as my basing, which is going to simulate a much slower growth for the first year or so, which is to say that it's not actually going to make a decline in the next year. I'm actually going to just simulate slow growth for the next 2 years and then have that start to accelerate upward towards the terminal growth numbers. But either way, so the expected revenue I have for effectively my 2020 it's like halfway between 2022 and 2023 numbers would be about 22.5 billion, which again, that compares to, for example, the analyst expectations of 26.2 and 29.5. So if I was to take an average between those two numbers, it would be 27.8 billion. So you can argue that I'm sandbagging their numbers pretty significantly in the short term. And that's not to say that I think it's actually 2023 that's going to receive it. It might be 2024. And it's not even, like I said, it's not really a decline. It's really just a significant pullback in the growth. And it's really because I do want to get to this terminal number here, but I do want to have a little bit of lower cash flows in the short term on their way to get there. That's just my own way of simulating that within the spreadsheet that I have built here, which has its limitations. Now their average tax rate over the longer term history that we have right here has been negative due to lots of lost years right there. So I have manipulated the numbers to get me an approximate 15% for their terminal tax rate, which is lower than the effective tax rate we would expect for their industry. But considering the losses they have, we would expect them to use loss carry forwards on that, effectively speaking. I do have tax rate information according to the profitable tax rate for the industry. According to the data set that we have right here, for over the longer term has been about 18%, the last 5 years 16%, and then it has been trailing downward for the last few years, relatively speaking. This is an aggregated number of profitable companies for their tax rates though, so it has a little bit of a funny way of calculating. So maybe 15% isn't necessarily too off of an assumption for a terminal tax rate. Now, as far as margin assumptions go, that's another point where we can come and look at that. I had already said 20% was kind of the longer term average for the semiconductor space, but we were seeing 20% in the most recent few years, and then 27% in the most recent year. Now you can see, for example, AMD had 24% in the most recent year, so they had lower than their industrial expectations. But as we had talked about, they have been kind of moving upward in their margins over time as they become more profitable, as they've gained a much stronger foothold in the industry. So I think that they will maintain pretty significant margins above their industrial expectations, which is why it's like if we're thinking that 19 to 20% as a good sustainable longer term average for their industry, well then I can see them maybe sustaining about 5% higher than that. So maybe about 24% over the long run. And then I'm willing to assume that a wider span of anywhere from 10% to 35% or so, with it leaning towards 25% in order to get that expected 24%. In the short run, I'm relying on their 5-year average, which is 21% for the base, and having it kind of then drift to 24%. And I'm not actually going to I'm not going to do a short-term conservative bludgeon by cutting their margin in half in the short term, like I've done like many of the other valuations. Like I said, I've already based down the revenues a little bit to kind of sandbag their numbers. I don't think I need to do any more sandbagging necessarily to their EPS. If anything, I think they're probably one of the companies that's more likely to do relatively well during a recessionary situation currently, just because of how strong of an upstream they have competitively in their industry currently. So anyway, that does get us an implied EPS across our expected outcomes for the next year of $3.02 per share at the current share count. And that compares, for example, against the expectations of the analysts of $4.62 per share. So again, if you improve the share count, maybe that would be $3.50 per share. So I do have EPS that's significantly lower than the analyst expectations for the next year, but I would much rather have my valuation based off of that than the other way around. In the longer term, the expected income for the 5-year forward period comes out to more like 11 billion, and that ends up with an EPS again based off today's share count of $6.82 per share. So I think that shows that there is significant growth in profits therefore over time across the various models. So now also we have a debt to equity ratio assumption, as I had said, with our approximation for the debt to equity ratio based off of the most recent quarter. They currently have a debt to equity ratio of around 2%. So I can't really assume that they're going to dramatically increase their debt to equity ratio, but I do think that they probably will increase their debt a little bit. And so I do have it on a range of anywhere from 10% to 0%, leaning towards 5%. And then that actually does get us an expected ratio of about 5%. Sales to capital ratio. And now this is the part, it's a little bit tricky, where, like I had said, we had seen that they had a higher sales to capital ratio than their industry, partially because they were a designer, and then they had their sales to capital ratio dramatically cut because of the fact that they took on a huge amount of assets, and then the sales are going to kind of trickle into the company on an accrual over time. So we have to think about where do we think their sales capital ratio can be in the longer term on a more terminal basis, especially compared to their industrial expectations. Now, we had already said that the 3-year average was about 0.75. That's 75 cents in revenue for each dollar of capital invested in the business. So I think we can assume that it might move up towards that over the 5-year period, which in and of itself would be like doubling the sales to capital ratio in a 5-year period, which is a dramatic shift. You don't usually see sales to capital ratios shift super dramatically unless you're buying companies or spinning off companies. So typically, if it's just due to growth in the business, it's going to be a slow movement over time. So even assuming that it goes from 0.35 up to 0.72 in a 5-year period on a natural basis, I think is a pretty dramatic shift. But so that's where I'm going to allow it to go, which does bring it below its industrial expectation, but we did allow their margins to remain above their industrial expectations. So hopefully I think that balances out for that, and allows them to remain a high financially qualitative operational business. And we do have that on a wide range between 0.5 and 1.5 with it leaning towards 1, and that gets us to the expected ratio of 0.72. So with those assumptions, that pretty much gets our evaluation in place so that we can kind of take it home and see the final summary. Now, let me adjust this. There was basically no default risk in the most recent year. I'll adjust that right there. With these assumptions in place, if you take a look across all the models, that does get us a return on invested capital on an expected basis, about 17%, which again, comparing that to the return on invested capital of about 8 to 9% they had in the most recent year, but about a 22% for the last 5 years on average. So I think that makes sense. That shows that they had the returns on invested capital drop because they had their asset base jump up pretty significantly, but they can see that the returns on invested capital will probably drift back up relatively close to where it was over time, because they still have, again, a pretty solid upswing in the operational aspects of their business. But it's going to take time for those returns to accrue due to the fact they took on such a huge amount of assets and therefore a huge amount of capital. But that does compare relatively to their cost of capital, showing that they'll still have a return on invested capital significantly higher than their cost of capital. So with that, we can take a look at the final summary for our valuation. If you're watching up to this point and you haven't already, please like the stream. Liking it helps attract more viewers to the channel, so please give it a like. That way YouTube will give me more viewers. And if you haven't already, whether you're watching it live or on the replay, please subscribe to the channel. Subscribe to the channel will give you notifications whenever I go live. That way you can come and join and be part of the chat and part of the discussion when I am live, as well as give you notifications whenever I release other content as well. As well as there's also the link that is the pinned comment in the chat, as well as in the description below, is a link to the Discord. Come and join the Discord. We share daily news, as well as chat about various happenings in the markets, the details related to our portfolios, and analysis of various companies. So come and be part of the conversation there. So AMD, Advanced Micro Devices, U.S. Treasury yesterday ended selling at 3.88%, a pretty significant jump in the Treasury as we've been seeing over the last week or so. The mature market equity risk premium, as I currently have it, is 5.95%. That has also been climbing pretty significantly. The discount rate that I come up with for AMD after adjusting for company-specific idiosyncratic risks is 11.28%. They do not have a cash dividend. Sales 5 years ago was 5.2 billion or so, against sales in the most recent quarter of 21.5 billion or so on a trailing 12-month basis, and that equates to sales growth of 32.65% for the last 5 years or so on a compounded basis. So huge growth in sales. Again, partially though, that comes off the back of the huge growth in sales most recently in the most recent quarter with the Exalytics acquisition, but also really just the last 3 years in general. Sales capital ratio is most recently 0.35 compared to the industrial expectation of the last 3 years on average of 0.75. So you can see that they have a long way to go to essentially bring that sales capital ratio back up to where it was, and it was much higher than the industrial expectation previously. Returns on invested capital for the last 5 years on average has been about 22%, and their debt to equity ratio is currently about 2% or so, and they don't really have any default risk, especially in the most recent year associated with that debt. Profit margin, their profit margin for the last 3 years on average has been about 24%, and that compares to the industrial expectation of their industry for the last 8 years on average. The longer term average has been about 19.5%. So we can see their profit margins, at least in the short term, has been pretty strong, though the profit margins of their industry in the short terms have actually been a little bit stronger than that even. But again, we had seen that they had been on a little bit of an upward swing in their margins over the last 5 to 10 years. Profit that they did have in the most recent quarter though is 5.2 billion. That is an R&D adjusted profit. They currently are selling for $67.17 per share. The probability distribution that I'm using for the valuation is our pretty much standard, our normal distribution that we typically rely on, where most of the value is based off of our median case mid model here. And we do have expectations of revenue of anywhere from worst case scenario $24.2 billion in the 5-year forward period to possibly $70.5 billion in the best case scenario. On expected basis, we see 45.8 billion, and that equates to sales growth of anywhere from 2% per year to 26 to 27% per year. On expected basis, we see about 16% per year. So very significant sales growth that we're implying into the company. Obviously, yeah, they've grown a lot over the last 5 years. We still think that they're going to grow pretty dramatically, and we kind of laid out the way in which they can make incremental gains in their market share. We showed that in our model earlier as to how we came up with those conclusions. Some people will say that we're being too optimistic and thinking too much growth into companies, especially when growth companies are currently being destroyed. Other people will say that we're being too pessimistic on an amazing company that's going to take over the semiconductor space. Can't make everybody happy. This expected basis of about 46 billion or so is what makes me happy. And that gets me sales capital ratio expectations of anywhere from 0.5 to 1.5. On an expected basis, we see 0.72. So we don't really see the sales capital ratio recovering quite as quickly as it had dropped with the Exalytics acquisition, but we do see them coming up relatively close to their industrial expectation over time. And that gets us to an implied return on invested capital on an expected basis about 17.33%. And that's with the debt to equity ratio of about 5%. So we do assume that they will increase their debt to equity ratio, both with market cap adjustment, as well as also them probably taking on more debt to fund the growth of their business over time. But we don't really see very significant amounts of default risk associated with that debt because of the fact that they have such a small amount of debt currently, and their market cap is so dramatically high as it currently is. Not to mention their pre-debt cash flows are so good as it is. So on an expected basis, their default risk is basically close to zero across all of these models, even with that increase of debt, which is pretty awesome. Profit margins, we have a distribution of anywhere from 10% to 35%. On an expected basis, we see 24%. Again, this is an R&D adjusted profit margin. And that gets us profit distribution of anywhere from 2.4 billion in the worst case scenario to possibly 24.6 billion in the best case scenario. That's pretty wide range there. On an expected basis, we see about 11.1 billion, and that equates to a present value after discounting back at the discount rates that we have applied across these various outcomes to $58.77 per share, which is 12 to 13% lower than the current share price. We have 5-year forward value targets unadjusted for any dividends that they could choose to pay out during the period of anywhere from $20.15 per share in the worst case scenario to possibly $236.91 per share in the best case scenario. On an expected basis, we see about $100.30 per share, which compared to the current share price gives us an implied return of 8.35% per year for the next 5 years. So that's pretty much it for AMD. That's positive returns, but definitely not anything to write home about. Nothing super impressive. As I had already said, there's going to be plenty of people who think that AMD for sure can knock it out of the park with some of these better outcomes. And if that's the case, well, I mean, then it does actually look like a really great valuation. And in fact, I'm not gonna lie, I tend to somewhat almost even agree that the fourth model has a pretty significant likelihood of happening. My assigning only 20% to it is partially just a conservatism. Like I said, I based it off of the revenue model that I put together more than anything, and trying to be a little bit more reasonable, thinking about where this median case model is. And I think that is pretty representative of a lot of risk adjusted situations of which the company can find itself in. These worst case scenarios, yeah, I definitely don't think that they're super likely. You could easily argue that we can maybe drop the second model down to 10%, maybe throw that extra 10% of probability onto the fourth case model. It probably wouldn't take too much convincing to get me to do something like that, which, might bring this up to 9 to 10% or something like that. I don't think it would bring it to fair value, but either way, interesting company. It's interesting to see that it's come down as much as it has, that it's now at least this close to fair value when it's been so far from it for so long. And we'll definitely keep an eye on it because, like I said, I think it's an amazing business run by an amazing executive team that seems like they have a decent amount of life left in them for a while. So it would be a great company to own at the right price, but I don't necessarily think it's at that price yet today. So that's gonna do it for the valuation today. I'm not entirely sure which company I'm going to be valuing next. I was looking at a few different companies before streaming, and certain ones that were kind of coming to my eye on my screen that I have right here. I'm kind of considering looking at Kirkland, a small furniture retailer, as well as Starbulk, which is another one of the shipping companies. So a few other companies that I've kind of been considering doing. I'm not sure which one it's going to be, but Thursday will be the next stream. You can comment below your suggestions for companies for me to value, as well as you can join the Discord and put your suggestions there. In fact, you might get a lot more of a direct conversation with me on the suggestion if you do it that way. So that's definitely the more recommended method. But either way, looking for other opportunities, or I'll just announce something at some point, probably later on today when I've made that final decision. But either way, I'll catch you all again next time.